Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Defining the environment is the idea of determining whether or not we're in one of these risk appetite environments or risk aversion environments. Does your trend model, is it validating that? The Australian dollar is the perfect example now. We're in that risk appetite environment. People want to get money offshore, into China, into Asia, into commodities. We're seeing those correlations very, very tight. Commodities up, risky asset classes, emerging markets up, all types of things moving together, Australian dollar moving together. All of that stuff is validating just the pure price trend. Again, gives you a little more confidence. And it also works in the other direction. If all of a sudden, you're riding this price trend, but all of a sudden you start to see a breakdown in these key asset correlations that were validating the trend before, that sometimes can be an early warning signal to you that maybe this trend is starting to turn, because these correlations should stay intact if this trend is going to continue to be validated. Again, not always the case. Correlations can break down independently. But again, I think these are some of the nuances that you can overlay on your model besides pure price to kind of just give you a heads up to look for some early entry opportunities in one direction or the other, or maybe even limit positions or start to take something off the table or tighten up your stops. All those things, all that money management when you're in the market of tightening up your stop loss or taking some money off the table when you break shorter term trends and reduce the size of your position, all those things are what really make you successful over time. So the more nuance you can provide on your trend trading model, I think helps you make those decisions a little better, even though price is still the driver. Simple trend strategies. Just going to look at really moving averages. I think that's really all you need. As I said, you can get into something like Bollinger Bands or various trading bands. ADX is another thing that's fairly popular. There's all types of things out there you can use, but I still suggest you just keep it simple. I don't think you add too much more power to a model when you start to layer on all this stuff. You can have very, very simple long-term trend following models, single positions. You break a 200-day or 200-week moving average, you're taking your full position and you're not looking back again until it breaks back down below that 200-week or whatever it is, long-term moving average. You're taking that single position, you're not adding to it. You just plan to ride this very, very long-term. Often when you look back at charts, it's amazing. Again, you think, oh, this is just too simple. It cannot be that easy. And I hit myself on the head all the time. Doggone it, it was that easy. It broke a major long-term trend. I should have bought the thing, stopped being cute, and just sat on my hands. And that's the beauty of using a long-term trend following model. You just make one decision, and you sit on your hands, and you don't get cute, and you don't try and pick tops and bottoms. It's amazing how this can work if you catch it right. And you only have to catch a few of these right over time to make a whole lot of money and make up for a lot of those losses that we've all made. Intermediate term trend. And I think this is really the most viable use as we talk about the FX options product. We're talking about a multi-lot position. A multi-lot position can be as small as two contracts. Can be 10, can be 50, whatever your size that makes sense for you, but we're talking about a multi-lot position. So say, for example, we take a 2-lot position. We can use a short-term trend, breaking over a long-term trend, okay, and that's your trigger to get in, so you're going to take your multi-lot position. And you're going to use a medium-term trend as really kind of your stop loss to take off half the position, and I'll explain this again. Once we get back above the medium-term position, you're going to re-enter to your full position. You're going to be completely out of this when your short-term trend breaks back down over your signal, which is your long-term trend. And I'll show you this on the chart. I know I went fast there. Very, very simple model. Very, very logical, and the money management makes sense. Again, short-term intraday, we won't talk about that, but you can use short-term intraday moving average pivots on all types of little swing opportunities, or at least potential swing opportunities that look like swing opportunities, I should say, that are really intraday trends if you keep your time frames very, very tight, looking maybe at 5 or 10 minute charts. It's an example of a 100-day moving average in the euro. Now this is an example of, as I said, maybe a one position trade. All of a sudden you're sitting here watching the euro, it's bouncing, bouncing. Here you would have had one of these whipsaws. You had a close, assuming your model said I'm going to trade on a close below the 100-day. Here you're going to go short, you did. You got whipsawed right out, but you're out the next day. No big, you weren't hurt. So you come in here, you have a close under the 100-day, and the last time it closed again was 100-day back in here. So simple model, not trying to pick tops and bottoms. 157, you went in around 157, you got out around 142, 141 on the euro. That's a lot of points. That's a lot of move. Look at the months there. 1, 2, 3, 4, 5 months. You made one single easy decision. And again, had you taken even a 6-month option, quite liquid on the ISE and the euro. Had you taken a 12-month option, whatever, that's a very, very nice trade. Single position, on a very, very, very simple model. And sometimes that is the best, depending on how much patience you have and the type of person that you are. Again, you can say, well, this is an example of an odd situation. Yeah, it may be, but we don't know when these odd situations are going to work. We don't know when they're going to happen, and that's the point of this. Even if we go further, we see a break here, probably didn't do too much for you, but you got a break here, and this move right here has made up for maybe some of this shaking out in here. So again, as I said, it only takes one long-term trend move that you catch in this very, very simple model to make up for some of these simple whipsaws. And again, the simplicity of this is you're making one decision. You're not having to stare at the screen every day, and you're not having to evaluate every fundamental thing out there. Okay, we have 3 moving averages on here, and this is the Australian dollar. Again, a little bit of cherry picking because the Australian dollar has trended so well. But I'll show you this in the Canadian dollar, which it hasn't trended as well. To give you another example of a commodity currency that wasn't as easy in here, and you did get whipsawed in. The purple line is a 100-day moving average. The red line is a 22-day moving average. The green line is a 3-day moving average. You see them here, 22-day red, 3-day green, 100-day purple, okay? Remember I said before, the trigger to get into this trade is the short term, the very short term, moving over the long term, whether crossing over to the upside or the downside.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.